Commercial property is attractive to some investors due to higher yields and long leases to tenants who cover the outgoings and even pay for the fit out. On the surface, this sounds like a no-brainer, especially for seasoned residential investors who may be getting a bit bored with the asset class. But what are the risks associated with buying commercial property? And if we're seriously considering this option, is there an ideal investor profile that we can measure ourselves against?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Today we're joined by Scott O'Neill, a commercial property specialist and the author of Rethink Property Investing. He's also the host of a podcast of the same name, which is created to educate more people about the benefits of commercial property. Scott is known for promoting high-yielding property, residential as well as commercial, and regular listeners will know that we're not fans of chasing yield in the resi space, but we're always open to learning. So thanks for chatting with us today, Scott. In particular, the commercial space is something we haven't covered too frequently on this podcast, so we're really interested in hearing your insights.
No, good to be here. Thanks for the invite.
Yeah, Scott, I mean, I've had quite a few clients and we've had a few listener questions, requests for you to come on. So it's good to have you here. I mean, we've probably done under 1% of our episodes on commercial, to be honest. I think we're clocking about 250 now and probably done 2 or 3 episodes on it. So it's a big gap and it's, thanks for coming on today. I guess just the commercial space in particular, I mean, there's obviously lots of elements to it, but I mean, you really focused mainly on that space. What drove you to go down that path versus, a typical sort of property investor just looking at residential?
Well, the 2 main things that drove me, well, number one, I was kind of forced to because I did reach a serviceability brick road, basically, brick wall rather, and the banks were not lending me more in residential. So I was like one of those standard investors, buying lots of cheap houses with good yields. And when I was a younger investor, that felt like the right thing to do. The cash flow was good. It was probably a different cycle. It was a different cycle in the market. Prices were lower, yields were better. It made sense back then. But once I acquired a number of properties and then APRA jumps in, all of a sudden the game changes. So that strategy did not work anymore. And I don't think it'll work again, to be honest. So because I had about 15 odd houses before I went into commercial, and it made sense until all the rules changed. And what I started seeing is, because at this time there's a lot of rapid capital growth happening in the residential market, so the yields were getting smaller and smaller. I was a unit block investor mostly, so I bought a couple of houses in Sydney, but then I was chasing high yield unit blocks. I was getting 10 to 8% gross returns. So that was pretty good versus the interest rates at the time. But I was really doing it for the strata tiling opportunities. So it was creating equity through that method. And all of a sudden, all this growth happened and the same unit blocks would sell at 6% gross yield. So it wasn't cash flow positive in the grand scheme of things once maintenance came out, rates, insurance, etc. And then I was just looking online one day and I saw like a mini mart supermarket with a 5-year lease, and it was like a 10% net yield. And I just thought it was too good to be true. So I just researched and I called up hundreds of agents. I didn't take the plunge into commercial until about 12 months after I saw that first property. And basically the numbers drew me there. So it was a combination of getting forced out by tightening sort of yields and lending rules, and then basically the yield cash flow allowed me to go back and lend again. And I've never looked back.
I've got a question for Chris based on what you just said, Scott. It's interesting that you went to commercial because you were sort of tapped out in terms of the ability to borrow more for residential. But I thought it was the other way around. I thought that commercial required a much higher equity to enter into the space, and in fact, that's one of the reasons it's for a quite a mature investor rather than people just starting out. How does that work, Chris?
Well, I mean, you would have been putting a bit of cash in for these, and this is when interest rates were a lot lower, Scott, right? Yeah, and then this would have been the commercial properties would have been servicing themselves. Is that sort of how you were able to borrow more money?
Yeah, so there was one big difference. It was the lease stock loans. So because the commercial properties can effectively, you can silo the lending and you can do a standalone deal. And they didn't look at all the residential debt at the time. And this was when I was redlining back then. As soon as I could buy, I'd buy again. And that's kind of why I bought cheaper properties as well. I was impatient, typical young investor. And now I'm actually selling a lot of those cheaper ones now just to go into higher value commercial. So I know something you've said on your podcast previously, Chris, it's about quality, not quantity. I'm definitely of that mantra. You do not buy lots of small, cheap commercial. It's better to go the higher quality ones because they've got the bigger leases, more well-known tenants. They're just less mobile, these guys, and they're backed by big companies. And that's it's better for lending as well because banks like seeing stability and bigger businesses in better locations.
Absolutely. I mean, that's definitely the residential. It's like, well, what's the postcode? Is it high density? No. Okay, we'll lend X%. Commercial, it's like, what's the lease? What's the location? We don't want to get into that industry or how long, they're casual leases, but we're not lending on it. It's a real, they want to know a lot more, right? Who's actually, the leaseholder, etc. But I mean, you said there you want to get out of these smaller commercial properties and bigger ones, which that's very much aligned to what I was originally thinking around commercial. You're going to get much better sweet spot, much better value for money, better risk versus return. But what's that minimum? Like, where do you guys not buy cheaper commercial properties unless they're sort of super fund investors that want cash flow? Like, do you really say, well, unless you've got a budget of a couple of mil in commercial, it's not really worth your time? Is that sort of, how does it work?
Yeah, it's a good question because it is a moving target.
Yeah.
When I pivoted the business to go basically all commercial many years ago, you could pick warehouses up in capital cities for $300,000. We actually had a number of them under $200,000. So these are properties that an electrician or plumber might have, or some kind of like craft brewery, or any of those kind of like boutique industrial users. So great properties, easy to release. Those same properties now, like half a decade later or 6-7 years later, they're probably worth $700,000-800,000 now. So that's around the entry level at the moment. So it's a moving target. There's a lot of capital growth happening at the moment because people are chasing these cash flow assets. And remember, it's a much smaller market than residential. I think I'd love to get this figure because I've been looking for it, but what the actual value of the total commercial market is versus the resi. I think resi's around 11. Now, what is it? It's 11 trillion.
Just shy of 10 trillion. It's falling slightly. It's about 9.7, I think, last count.
There you go. So commercials, it could be 20% of that. So imagine if a few of those residential buyers come over the fence to this. That's a new demand that this industry hasn't seen. So that extra demand I'm seeing it because I'm on the coalface of people, running into the same problems I had, and it's a diversity play. It's a lending play, and cash flow is obviously becoming more important now that rates are high.
Do you think that a lot of your, younger accumulator clients shouldn't be going down the commercial route? Do you push them more down the resi route to build an asset base to leverage their income? Once they start getting capped out, maybe they start looking commercial down the line? Or do you think that, commercial is a way for them to build wealth initially?
It could be both, but look, I'm a spreadsheets type of guy, and one thing residential will always offer for those younger guys is a better return on equity if there's growth, because you're putting a lower deposit down. So imagine you're putting 5% down and that market's going at 8 to 10% growth per annum for 10 years. Whoever that is, you've done very well if you've been able to cover that mortgage over that period. So it is a capital intensive world, commercial. That is probably the greatest barrier to entry outside of just Intel. People don't understand the market. So you need about 250 grand in this day and age to buy a decent commercial property. You need far less with residential. So if you're a young guy or girl looking to start, especially if you're doing it on your own, residential is lower risk because it's hard to screw up residential long term as long as it's not in a big floodplain or it's not riddled with termites and you're not overpaying by a huge amount. If you buy a dud commercial, like a little corner store in a back alley, it's forever a dud. You can't fix that. But this is where you've got to be smart about it. And if you're buying the best corner side or the best industrial property in a growth market, it's higher risk, but the returns are higher due to the fact you can kind of, it's not as a homogenous property market, rather. There's little angles you can play.
Yeah, so that makes a lot of sense in terms of, and we'll talk about that on a question in terms of where can it really go wrong, because I think that's really interesting around the quality of the asset. But I mean, you got your entry price, say 800 to $1 million to buy a warehouse for a brewery or an electrician or something like that. But let's say in a lot of our cities, where do you think that the real sweet spot where you really get that bang for buck, right? You do get the better tenants, you do get the more scarcer blocks of land, where you're always going to get demand in, all markets, and where people are going to compete for leases, and really push rents up. So where do you find that sweet spot, changes around the country?
Well, as of the time of this property podcast recording, we're probably looking at around 1.25 mil and above. This is where you leave a lot of the mums and dads, beginner investors behind. You can start getting freehold assets. You're dealing with, a 300, 400, 500 square meter building instead of a 120 square meter building. So naturally the tenant's going to be bigger. They've got more stock. Yep. They're probably more of a mature business. So instead of being in the startup phase, they've been around for half a decade. So their growth has slowed. So they're not going to outgrow your property as quick. But the real benefit in that price point is there's just it, and that's still kind of like almost entry level. The competition starts getting a little bit easier, because that sub $1 million range in 2020, 22 it's a supply chain train wreck. There is hundreds of buyers for every property because everyone wants a little commercial property, and there's just not enough out there. So we're finding yields are getting too tight. So you're not getting the great deal unless you're buying it off market, or you're just getting lucky. So once you spend more, you're basically out purchasing more people. The quietest zone in the market is probably that 3 to 8 mil range. Above 8 million, your syndicates and your super funds and all your big boys start jumping into that space, and they've got money, endless money. They're just parking up. That's why there's still $100 million towers in the city transacting, even though you and I probably wouldn't touch an office space in the city. They're just playing long-term games, buying and holding good real estate. So, so the best range is you're in the millions, basically.
And do you find that it's, of those hundreds of people lined up, do you think a lot of them in that sort of 55 or even 50 plus range that, they're starting to get away from it's not about the growth and building an asset base. It's now about sort of de-risking my retirement and getting a real steady income stream. And maybe it's in super and I don't really want to have it in the markets anymore. I actually want it in an asset that I'm going to know I can get my steady income from. Do you find that that's where most of the players in commercial are is in that bracket rather than the accumulator young guy or girl who's trying to build an asset base?
Yeah. So best way I could answer that question is just probably talking through my average client. So my oldest client's 85. He bought a shopping center and, still loves it. Youngest, probably early 20s. So most of them are in their 40s, 50s. So they are older. So what you described is correct, Chris. It's someone who's established. A lot of business owners. Business owners love this because they understand leases. A lot of them are parking profits up, and it's almost creating a side business because it's a profitable business that is quite passive as well, and just mature investors, because like the larger your property portfolio becomes, the more important it is to look after your time, and it's less so about stretching the money as much as you can. So commercial property, when you do it right, is much less time consuming because you're dealing with one tenant or very long leases. There's just less touch points. The rental managers they're a different beast on generalizing, but they are business people that will sort of look after a lot more. And and your average tenure of a property, they're not like in residential, it's probably 18 months, or less. Commercial, it's probably closer to the 10-year mark. So you get bigger vacancies, but it's all up front. But then when you get your right tenant, you hopefully got them for half your life if you're lucky.
So I guess the due diligence process, looking at commercial property, is obviously going to be completely different to a residential due diligence process, because you've got to be looking at the type of tenant and the type of, business profile. Those long vacancies would be rather scary. And so obviously you need to be able to fund those if that occurs, and think about, well, who's going to replace whoever you've got in there, or if you're buying it vacant too. And I guess it's sort of interesting too, because the value of a commercial property is really calculated as a function of the yield, right? So in terms of the multiple of the yield, what sort of, where does that differ? Is that a sort of a dollar-based thing? The more expensive the property, you would think that the yield is going to be a bigger factor in working out what the property is worth, or is it at the lower end of it that you get more competition amongst buyers and that's what's driving prices? So what would drive the yield? And then the yield obviously becomes a function of the sale price anyway, or of the value of the property. So it's all sort of entwined. But what are some of the issues that in the due diligence process that people need to be aware of that are completely different to residential?
Yeah, no, great question. It's a complex one to answer because there's so many different layers. So firstly, what justifies the yield? So many things. So industry, asset class, length of lease, age of building, potential for growth on even things like the raising build costs we're seeing at the moment. That actually flows through into future capital growth because it decreases the supply of properties because developers can't make their margin.
Yeah,
so
okay.
it's the same stuff that happens in residential. As build cost up, you're not going to see off the plan apartments built at the same price. So that's good for existing stock because it'll slow supply down. That's good for rents. So we're seeing a rapid rent growth phase. But Veronica, to answer your question, it's due diligence is the most important thing. Like it's taken, like basically I've got a dedicated team at my company, Rethink, to do all the due diligence. They're basically a bunch of guys that have all different backgrounds, some developers, some valuers, investors that have worked for managed funds, stuff like that. But they will look at the rent rates. This is the first due diligence thing you check. Make sure the rent's not overstated. It's the easiest dodgy game in the book to, your uncle's going to make a fake lease, double the rent, and then 10-year lease. It looks great on paper, and some people go for these. This is where your first-time investors can get really burnt. You could overpay the property by a factor of 2 without even knowing
for sure.
it. So the way to cut through that mess is just check market rates. And then you can start going, all right, well, now I know the fair market rate is roughly where the current rent is. Is that tenant viable? So we want to see bank statements from at least for the last 3 years. I want to see how these guys went in COVID. I want to make sure that they're just not a company that's in decline. Like what's their competition in that area for, like if it's a gym, are they building another gym next to it? All that kind of stuff. And it's hard. And if you haven't been exposed to the business world and been around this stuff, it's hard to sort of get it all done in the right time. So you got to act quick because you only got 21 days generally to act on all this stuff. So the yield is the hardest bit to factor because it's like you guys, when you're looking at a residential property, you need to sort of know where the market's heading. You can look at comparables and obviously there's a lag in data. The worst thing about commercial is there's almost no data out there. Where do you get an average yield for medical centres in Adelaide? Good luck. It doesn't exist. So it's got to be manually sourced through agents. So your Colliers, CBREs of the world. We're lucky because we see hundreds of valuations a year. So we kind of make sure we take account of every comparable. So it's almost like an inbuilt data system because without it, you are flying blind on the yield if you're coming in to buy your one property per year or half decade. So that's the due diligence. Don't overpay for it. Make sure the rent's good. Make sure your tenant's not going anywhere. We call the tenant up as well. I want to make sure that tenant's happy with the building. Tell me about your car parks. Is there any leaks in the roof the builder missed? Just chat to them. They'll tell you a lot. And if they're not happy, don't buy the property.
Yeah.
It's interesting, isn't it, to think that it's much more opaque than residential space. Residential space has a lot of information. Generally, it doesn't mean people know what to do with that information or how to properly assess it, but it's there. And whereas here you don't have it, or you've got to know where to go to get it. And then there's not one database you plug into and sort of spit out all those comps. But also, I know with auctions, for instance, the rules in New South Wales of bidding at auction, they're a lot looser around commercial space than they are in residential space, because there's that assumption that a commercial buyer knows what they're doing. Whereas I would imagine, and given the opacity of, the information and the ready access or the access to data, I would say it's a highly dangerous space for the uninitiated, and certainly those that don't understand small business as well, because a lot of these properties are tenanted by small businesses. It will be a minefield.
Yeah, and that's 100%. That's where the risk in commercial lies. If you don't know what you're doing, you don't just jump into this because the yield looks good. I think commercial is actually less risky with residential because I know it. I actually know where the rents are going. I can value it to the decimal point, I feel, because it's a lot more numerical based. There's a lot more sentiment in residential, and residential is so driven by even just media headlines. Like, I saw last night they're talking about 20% crashes, but they're not factoring how great it's all gone the last 2 years prior to that. And no doubt 50% of people will probably hold back and go, it's a terrible time to invest now, but right now is probably the best time to invest in the last 12 months because it's now priced a bit better. And there's a bit of that kind of unpredictability that in residential, which I find harder to understand. Commercial, it's square meter rates. It's like spreadsheets, numbers. It's so boring but predictable in a way, which that's why I kind of feel comfortable with it. And and you just got to make the hardest bit is working out which trends business are going on. So like office spaces, more people working from home. Obviously, there's going to be less need for that. Industrial's picking up the slack. Essential retail's going as strong as ever. You got to look into upcoming DAs. If you buy a shopping centre, don't make sure there's not a big new one going in. If it does, make sure you get the current one at the right price because rents may drop. So you've got to factor in all those things.
What do you think about like markets? So like, certainly residentials are very heavily driven by investors, for example. You might think high density, right? And when investors aren't buying, they get smashed. But, obviously commercial, it's all investors, right? It's not people buying houses to live in, right? And so there's not this underlying need I'm not selling because I need somewhere to live. I mean, how do you think that, we've had a bit of a tailwind, I guess, drops in interest rates have forced more people to get away from cash into high yielding investments. You're leaving your money in the bank, you're getting nothing. You can't do that. I've got to buy anything's better than zero in the bank. I might as well just buy a commercial property. So, how do you think that flipping into higher interest rates, do you think that's going to be a real really split the commercial market? The quality assets can survive on lower yields because they're very scarce and they can keep increasing their rents. And then the other sort of commercial properties that were highly priced because there was just desperation about searching for yield, they're going to really struggle because of they don't really stack up onto higher interest rates. Is that sort of your take?
So interesting comment. So there's a very strong owner-occupier market in commercial, but some sectors have more owner-occupiers. So think about industrial sheds. We lose more bids against owner-occupiers. Now the rates have gone up. We're actually seeing more people are happy to sign that 5-year lease because 2 years ago, all your good tenants wanted to buy their own shed. It was very frustrating because it's like we can't like we're competing against this other market and yet they don't want to rent. So it can actually increase vacancies and the price for a vacant shed and one with a good tenant, it was the same money really. So right now the power's gone a little bit back to the investor because there's more tenants looking because the owner occupiers are more hesitant to take a bank loan out. So the investors still want a return on their money. So your comment's very correct for things like office or small retail. We like buying freehold shopping centres where you might have a supermarket and a bunch of small tenants like hairdressers, physio, pharmacies, stuff like that. They're mostly renters. So they're normally funds own these, or a high net worth individual, and then they're tenants forever. So that's probably more true, that comment in that sector, and office space, because people tend not to buy their office space as much as they would. So there's more just institutional money in that side. Like all the big towers in the city are owned by, Stocklands or Aqualand or those big companies that we probably all own a piece of in our super.
It's interesting you talk about the owner-occupiers because I was thinking about that in the odd times we've bought commercial in our business. We only buy for owner-occupiers. We're not geared up to do all the analysis for commercial. It's not we don't know it. We're not familiar enough with it. But I would still hazard they're probably not quite as emotional as somebody's going to occupy it to live in a property.
Yep.
But there's also this self-managed super fund space where, I've heard and I've seen or met lots of people who bought small office space in their super fund. And so that's another, I guess, aspect to the owner-occupier, although technically they're not, because technically it's a super fund that owns it, not them.
Yes.
But we all know what we think about that. Since we've had lockdown, since there's been this work from home movement, a bit of a U-turn happening, hybrid models, all the rest of it, where are you seeing the trends in terms of the demand for different types of commercial spaces? Because, retail's had quite a significant change, and certainly the office space has had a significant change. I guess your plumber who's got the industrial unit, they're not, that's not going to be a great change. But certainly those two other sectors have had quite, I guess the impact that they've had from COVID has been quite different. And also like pubs and spaces like that. I was reading today, Inner West Council in Sydney is putting on the heritage listing register 17 pubs because they don't want them being repurposed into other types of spaces. So it's sort of interesting that they need to do that to stop, because these properties, obviously, if they were on the open market, they didn't have a heritage listing, were starting to be worth more with a different use. So what sort of trends are you seeing at the moment?
So, yeah, the big one is the office market. So, I was in the CBD an hour ago, and it's just not the same. It's still like, how long has it been? There's less people in the city at the moment. That resulted in about a doubling of the vacancy rate. So, things went from, say, 6% to nearly 12% during COVID. So it wasn't great. If you owned office, you're basically going to have larger vacancies. And that's a space we never invested in because it's like a high density one-bedroom unit in a overpriced suburb. It's always going to have a different level of risk. There's a lot of similarities between commercial and residential. Like it's, if you're owning the freehold in a good, core middle ring suburb, and there's, and it's a decent building, it's pretty hard to go wrong. It's going to have that natural capital growth because, everything's attached to inflation to a degree and it's leveraged inflation. So those suburban neighbourhood shopping centres improved after COVID. Medical properties improved because they were viewed as recession-proof. There was things like boarding houses, and that declined because they've got vacancies and less international students and all of the above, that less migrants bring. They're going to make a comeback, no doubt, because there's several 100,000 people planning to come into the country in the next few years. That's going to be horrible for the leasing market, or if you are renting. So rents are going to skyrocket. They need to work out how to fix this supply problem on a residential front, but commercial is going to benefit from that because a lot of these people are going to work in the city. A lot of them are going to work in factories. So, but look, the golden child of COVID was industrial. That just went from being a second tier type viewed property to being the one everyone wanted. Like for the last 100 years, office and retail were premium. Industrial was viewed as just a dirty shed in the outskirts of a city that you could replicate many times over. That's just so far from what it's been viewed as now.
So I mean, if for the commercials, a lot of it's based on yields, do you find that unless you know what you're doing, you could very easily pick the commercial property with tenants that can't afford rent increases, right? And so to assume that you're going to get inflation or above inflation rent increases, the leaseholder can't afford to pay higher rents, maybe because their profits are getting squeezed, etc. Maybe there's oversupply of takeaway shops, for example, or whatever it might be. So is that one of the big risks you see a lot of commercial investors get wrong? They just assume that that when they release it in 5 years' time, they're going to be able to increase their rents 20%, and they end up just basically getting a sideways. So the yield still looks good on their initial purchase price. So they're still getting 5% yields, but unfortunately that rent just stayed the same for 15 years. Do you see that those sort of issues pop up?
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers. And if you'd like a 30% discount plus free postage for my book Auction Ready, How to Buy Property Even Though You're Scared Shitless, and yes, I'm a potty mouth, use the code ELEPHANT at the checkout. veronicamorgan.com.au.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
Look, that'll be the good thing to get. That's what I want to get my head around, if it's even possible, what's going to happen in the next 5 years, because rents are going to be increasing rapidly. What impact that has on businesses will be very interesting to understand, because right now they can pay it and they are, and if they don't, there's another 5 tenants ready to take that property. Will that change in time? It will at some point, because everything has a limit. But by then, that's probably going to be what I would think the end of this inflation curve. It'll start coming down. People will stop spending as much. Maybe that'll coincide with the decline of interest rates. I don't know yet. We'll find out altogether. But yeah, look, where I see people getting it wrong with commercial is those classic auctions where they've got a service station and it's selling at a 4% yield in less than perfect area. These guys, like, I wish I had them as clients, because we could double their deal. You know, it's like they're buying absolute junk at terrible yields, and they're paying like millions of dollars. This is not a 500 grand purchase. They're paying 5, 6, 7 mil for this stuff. And I've spoken to many agents over the years, like, who are these people that are buying these properties at these ridiculous prices? And they're just cashed up retirees or people that literally don't even have a bank loan and they don't care. They just want to park it up, enjoy their 15-year lease. If it goes up, it goes up. It's just, it's a counter move to just sticking it into the bank. That's all it is. And they've got enough money to play with those numbers. So it's a different space, and that's who they are. But they make mistakes.
Yeah, I mean, I guess it's, there's obviously some areas you've got a real undersupply of industrial or, retail in certain pockets. How do you think about the investor, though, that's on a higher tax rate, right? Like, so, when you're earning more than 180 and maybe your partner's earning more than 180, and so whatever you make in yield, you lose 50% of it. How do you think, how does that play into your sort of strategy, and whether they should be looking at things that aren't focused on yield or focused on, say, capital growth, where, they're not losing 50% of it today. They're paying capital gains tax when they sell an asset in 20, 30 years' time. And, does that matter to your strategy? Do you think it really suits people who are on lower tax rates and, super fund investors rather than sort of your high income hitters?
Yeah, look, it's a good question, because it's something that comes up a lot, because most people who buy these types of value commercial properties have good income. So the one good thing about commercial is you're getting the full depreciation benefits. And I'll just use some numbers on this high net worth individual who was purchasing a $9.2 million property, 3 drive-throughs, and this thing was new. The cash flow from this was just under 600 grand net. That was after outgoings, but the depreciation benefits on it was 390 grand. So 390, you can work out your tax. You're only going to be paying it on just under 100K on that tax. So it's actually quite tax efficient. He's not going to be paying much. He was probably setting it up with separate trusts and, family unit trusts. So there's not going to be much tax to pay on it, but it's a significant high cash flow investment. So they're making money on the pre-tax return as well. So that's
so to get that depreciation with the commercial, just that's obviously reasonably renovated, has it, or is that?
This one was like a new asset, so that's why that depreciation was so high, and it was one of the reasons it suited this client, because the post-tax return was actually a fantastic yield. So compared to buying something that was 50 years old, that 400 grand wouldn't have been there. So it's a big offset.
But do you often see that percentage of depreciation? I mean, that would like a bit of an outlier. Like, is it usually not that big of a deduction unless you're buying something that's recently renovated or recently built, which you're probably paying for a premium for anyway. And there's probably more demand for that stuff because it's probably seen as lower risk and, easier to rent, I guess.
That's one of the better ones, but most of them aren't too far from that, because think about a commercial building, like especially if you buy a 10-year-old industrial property. So much of the value is trapped in the bricks and mortar or the slab. It's a high wall, so there's a lot of value that you're depreciating against in the building. So, and then there might be like internal fit outs and all sorts of other stuff. So they're very expensive buildings, and that's the difference. So a house, you're paying a lot for the land, that's good land is where the appreciation will come. Commercial, there's more value in the building itself. And that's why those big towers in the city are just, that'd be enormous returns on those, because after tax, there's a lot to play with, basically.
Well, I guess ultimately, even in residential, what people are paying rent for is what's on the land, not the land. So you can see that with a small unrenovated house on a huge big block of land right next to a mansion, and the rent will be different based on what they're actually renting, which is not the land itself. So I guess it's the same in commercial, but obviously you need to have a pretty good accountant on board to be able to work through all the levers, because with residential it's sort of pretty limited in terms of how you can structure I guess your investments and how you work them, whereas it sounds like in commercial there's a lot more flexibility with how you, and also I noticed that when you calculate yield or return on investment, you're actually calculated in terms of cash flow, which is great. And I actually think that people probably should look at that too when they're looking at residential property. It's useful to do that and then assess it against whatever capital growth you're getting, so that there's an honest way, I guess, of measuring the caliber of your asset. But certainly with commercial, that's more important, isn't it? I mean, how do you work out? I mean, we've talked about how you work out the value of a property. And it's based on the yield. But like, for instance, I read one of your articles on your website that said that in a 2-year period, the value of your portfolio went from 22 million to 47 million in 2 years, right? So how much of that was capital growth versus acquisition, and how did you calculate that capital growth? Where did this 25 million miraculously come from?
So it came from a few things. So I was lucky enough to buy, a place in an affluent eastern suburbs property in Sydney. So that literally doubled during COVID. But where I sort of got the most gains was I sold about 5 million of assets down. And these were my lowest yielding properties that I just thought have done enough. There was less upside in it. So I then sold all that, paid the tax on it, used growth from refinancing and plus some other savings, and then went into larger deals. So what I basically have been doing, and I'm still doing, is I'm transitioning out of those sub-$1 million residential houses because they just take too much time, and it doesn't really worth getting out of bed for just a couple of $100 a month when other properties are giving you 100,000.
Yeah,
and that's so I'm going into those larger assets, and that's that'll be the long-term thing, and so less is more in this case. It's just less properties, but higher value ones. And they're a little bit safer too when you go into those higher value ones too, I think.
So it was really a restructuring of your investment portfolio,
completely,
rather than happen to be sitting in the right place.
Well, you must
at
have
the right
got
time.
some big growth though,
Yeah,
because to take a portfolio from 25 to 47 million, you must have, in that restructuring, yes, your house went up, but you must have almost like manufactured growth, or got really bought in. 2018 was a pretty dire market. So if you were able to transition out in 2018 and then got all the uplift with a massive drop in interest rates, which got a huge increase in people chasing yield, right, and chasing growth and FOMO. But I mean, 2020 wasn't before it really kicked off. So I mean, that number's obviously changed as well since then. Do you think do you think manufacturing growth, like with resi, I mean, you can try to manufacture growth. I think it's a bit of a mugs game a little bit, unless even the townhouses and the small, I very rarely see people walk away with a huge gain for all that. Unless they were like privy to something that, I don't know, they got a DA through that they probably shouldn't have, or, something like that. Whereas if it's an area where they're all building townhouses, one works, the next one doesn't work, and they wipe out their gain. So, but commercial, do you think that the smarts is also manufacturing that growth? How could I repurpose this land holding to add more yield, add more tenants, go higher? Is that the real where you get the big capital uplift? Because that's where you increase your rental base, which can really drive. And then also, opportunities where people are renting it out for too low, like this just they got a bit lazy with reviewing their rents.
Exactly. Yeah. So like one of the big wins I had, it was a shopping centre, regional Queensland, renegotiated 3 leases. There were 6 of them. So it went from 4 mil to 5.2 mil. So that's just from lengthening leases. And there was a couple of years of rental increases in that as well. So that would have bumped it up. But, that's only, 20, 30% uplift. So that's, if you can increase your rents by 10 or 20%, that's your equity. So I'm doing that on another shopping centre deal I'm doing where we can add 150 odd thousand of rent. So if you capitalise that 150 divided by 0.6, a couple of, 2.5 odd million there as well. So increasing rents equals capital value, essentially. So if you can find deals that you can increase the yield, it's going to be backed by a valuer just through the market capitalisation rate, which is how they value the rent in that market. So the lower the cap rate, that would be like a Darling Harbour CBD type property. It might be 3% there. So like that means your rent's worth more to a valuer. So yeah, the higher the yield, the less important that rent is, I guess. So, and the higher the risk essentially. So you manufacture equity those ways, and that's why I think the upcoming period is going to be quite good for commercial investors and resi guys too, because the rents are growing, and that's going to be important for the long-term viability of these investments. So rent growth it's almost a forward indicator of future capital growth, even for residential, because now that all the rents in, say, Brisbane or whatever have jumped to $100, it's now looking like the yields are more justified now. So it's creating fat in the deal down the track, I think. Commercial's just a little bit more sensitive to that.
And on the finance, I know you guys do your own finance probably for a lot of your deals, but how are you finding? Because one of the things we're not commercial specialists, right? We do 98% of our loans in resi, and people buying their first house, upgrading, renos, 1 or 2 really quality investment properties. Our average is quite high. It's probably like 1.5 a client, so it's not what traditional resi is. But we're not here to say we know the commercial market, but when clients come to us and they have bought commercial, or they've come to us and said, "Oh, can you help me with this?" We find that the LVR thing catches people out, right? Because banks come in and out of what they're willing to lend on certain. So when you're assessing the deal, is that one mistake you see a lot of people make? Is they just don't understand how the finance and how banks will look at that commercial property and what LVRs they're going to require and what's their lease conditions, etc. And so do you find that within 21 days, that's actually quite hard? Like the commercial space, to get good answers, unless you know the commercial space, you can get wrong there. So is that one of the key things that people get wrong with commercial? They don't know how to understand the finance element. So then, because what someone can borrow on it really ultimately determines the price, plus what cash they've got. Because if everyone can borrow 90% on it, then obviously it's going to be worth a lot more than if everyone can only borrow 20% on it, right? So, how do you sort of, look at properties and say, well, we're not going to buy that one because we know that no one wants to go into childcares right now and they're only going to lend 40% on it or something like that.
Yeah, and that's probably one of the main reasons that even in 10 years ago, I wouldn't have touched a service station, because it's like 55% funding. So less return on equity because you've got to put more cash to get the same price. So sub-million, you can do 80% loans currently, which is probably fueling some of that extra demand at the moment. So you're 100% right. One of the biggest things when people come to me and look at the finance, like, because we put all the numbers out, like stamp duty, the cost of evaluation, the building and pests, and it's always more money than they initially think. So 30, like if you got 300 grand, you can't buy $1 million property because you got 50 grand in stamp duty, you've got 20 odd grand of other costs.
Application fee on a mortgage is 40 basis points or whatever.
Exactly. So that eats away at your expectations. So you're probably at 800 all of a sudden or less. So that's a big difference, because residential investors, they don't look at the numbers as close. Like your comment about the gross returns, Veronica, it's so true. And I think the sooner the residential industry starts quoting net returns, the more honest it'll be, because you can't say a unit in a high rise is a 6% gross return. That's a ridiculous comment to it. It's going to fool someone. It's designed to fool someone because they've ignored $3,000 of strata. So quote numbers that are correct, and that's net.
It's funny, actually, when we do our gross yields, we do a sort of a gross slight net yield because we always take into account strata levies, because that's the one big variable. I mean, houses will have council rates and water rates and apartments that in that, and that is very different from building to building. But I think too, on the commercial space, I mean, you've got a lot of different options that you might be a little bit more agnostic to location, whereas in residential, there's 80-20 rule. The location is pretty much well regarded as being 80% of their heavy lifting. So you buy, from what I understand, across the country, right? You've got city markets, you've got regional markets. How do you sort of work out what's a good location for a commercial property? And I imagine it's not as simple as it would be for residential.
No, because it's almost to the street level or even the property number. So especially retail, you know, in every main street in your local town, there's going to be that great corner location, and then 20 meters away, it's going to be just out of sight. So, or there's no car spot. So you really got to understand like exactly what's happening in that specific market. So, and even just looking at what other tenants are in place, you know, that's a big part of it. If you go regional, there's nothing wrong with regional as long as it's not a declining town or a one industry town. That'll, you know, like I saw my father lose half his life savings in Moranbah. You know, remember that famous
mining town.
Yeah, terrible. So I've always hated mining towns as a result. But if you're buying in a town that has every other fundamental, or even if it's a mining town but it's at that new cheap rate and it's never going to go lower, like it's just understanding the true fundamentals of the area. And as I said, a good building in a good location with lots of foot traffic or highway traffic does change it, and that's where it's very different from residential. Like highway traffic is good, residential it's bad.
Very true.
So Scott, have you got a property Dumbo for us? I'm sure the commercial space there'd be plenty of them. I mean, over the years where you see people rocking up at auctions, throwing big numbers down, and you're shaking your head, and lots of other issues with due diligence. There'd be thousands of things you would see on a weekly basis.
Well, something that's quite topical, it's at the upper end, but you know, us in the office had a bit of a laugh at. It was circulating on the news that someone bought a Bunnings $80 million with cash at a 3.9% net yield. And we've all just been debating, like, why would you want a 3.9% yield? Why has this guy got 80 mil cash? Why? Like, it's just all these questions because it was just such an overpriced purchase that us investors who want returns on money, that we can't get our head around. But some people just lose their mind and get too romantic over a brand of a business or a tenant. That's where they'll say, I need a childcare. I'm going to buy a childcare because I understand it. I've recently had to go through the childcare system. It must be good. But if that childcare business is not viable, and they're out there, those ones, then you've just got an overpriced house. So you've got to be really careful with those. But it's just the auction houses. They just somehow it's like a two-speed market. There's a price at an auction with big well-known real estate companies that just line people up for the slaughter there, and they just get almost 20% over market rate all the time. And that's kind of the thing we find funny as buyers agents, because it doesn't happen as much in residential. Like, you'll see those outliers where the two people fall in love with the property and push it way above the reserve. So there's that. I guess, like we've seen people buy in towns that have been bypassed, by the Red Rooster on the highway, and then that highway doesn't go through there. Like, that would be a horrible situation to be in. So that's, make sure they're not diverting the road in any way. And, a lease is only as good as the lease. Like, if the business doesn't work, they'll fail on their lease. So it's got to be a good business behind it. But, the average case study, like, our average purchase price is probably just under 2 mil. People are either going like a multi-tenant retail or a industrial property. You get a 6 to 7% return. So if it's a $1 million property, you get 70 grand clear. Your mortgage on that, if you're 70% loading it, it's what, 40 odd grand a year. So you're clearing 30,000 after costs. So that 600 a week in your pocket is what people are still attracted to at this stage. And then you get your depreciation and your capital growth, because inflation, if that rent goes up 6% this year, that $1 million property is now worth 1.06 mil next year. So you make a pretty good money for not doing too many risks, really, I think.
Around the borrowing capacity with commercial lending, it's, if you're noticing that you're going to have to start to continually buy, you're going to need a bigger and bigger deposit, right? because of the assessment rate? Or are you finding that once you're sort of at a certain level that you can still keep on just borrowing money? Like, what are you sort of finding for your bigger clients that, some of your smaller commercial properties are capping out pretty quick, and then the bigger end are able to just keep on borrowing as long as they're smart in what they're buying?
Yeah, so it's deposit limited. So you can lend forever, basically, if you're getting the right yield. So I've got like one of my largest clients, he's got over 300 commercial properties, but he's got huge amounts of equity and credit. It's taken him a lifetime to do that, but there's no bank that'll say no to him if he presents a 6 or 7% yield property and it's got a 5-year WALE on it, weighted average lease expiry, and it's a good core asset. Like, so the banks will keep lending, and you're dealing with a different department of the bank too, private wealth, and they will push limits for you, but you're generally working off 65% loans max at that range. So it's lower debt again. Yeah.
So that, person buying at 2 mil, for example, needs 700 grand of cash or equity in other assets. And, to do that, then you're going to need a big asset base. So this is, I guess, why you find it is heavily weighted to sort of the more sophisticated, bigger balances, because they can keep on, you can't just keep on borrowing for commercial unless you've got cash. And, so it's like sort of a catch-22. You want to do it, but then you haven't got the cash, then you've got to go and build the cash some other ways. And do you think that's why, your average is 2 mil, right? So that's, you're talking, a 30% deposit, you're talking 700 grand. It's going to really shift towards that sort of 50 plus range. Is that why you opened the residential arm? Is that those younger investors that haven't got those big cash, that they look at these sort of more resi area?
We always had the resi, but yes, you're right. It is more deposit limited because a lot of them want the commercial, and we just say, look, it's not right for you. The deposit is too great. You're going to not get the leverage you need. So this is the great thing about residential in this country. It is, it's allowing people to get into that next level of wealth. Like, if you do it right and hold it for a long period of time, you don't have to use much of your own money. 90% of it's the bank. So that's the key. Once you've got the deposits, like I see these people that, they say they buy 50 plus houses. To me, that's like a child collecting toys. Like, that is a ridiculous thing to do, because a smart investor would have stopped by then and started buying higher income, more sophisticated assets with better returns, because they've got the equity. You can't just jump into it if you don't have the money. But once you do, if you won lotto and won 20 million bucks, like, buy a couple of shopping centers, and you'll never work again. You don't go buy 20 houses in, a bad part of a suburb.
What do you think about tax-free growth on your home? Tax-free growth on your home versus, you're paying capital gains tax on all your commercial property, and, I guess, and then also, you've got super, and, people leveraging their super into commercial, which, it's that can work really well, right? Especially when you're selling that into retirement, and especially if it's your premises, etc. So how do you think the capital gains tax exemptions and people being smart around that matters with commercial?
Well, it's probably, like, my experience is it's almost the last asset you sell. Like, because people who own a commercial property, they've probably got a bunch of shares, they've probably got a bunch of houses, their home to live in. So the last thing they will sell is probably their home to live in, unless they're downsizing or whatnot. That's obviously amazing because there's no tax. So that's, you can't complain with that. But you generally will hold on to this asset because it's your highest income and it's the lowest touch point. And if it's gone well for 10 years, it's probably almost got no debt on it by then as well, or very little. So your LVR might be 20% at that time or whatever. So my experience is people often don't sell. And the reason they do sell, like, because I'm negotiating on properties every hour of the day, the main reason people sell are they're either dying, in their late 80s or whatnot. There's divorces. And the other thing is funds selling because they've got this, like, 7-year sale mandate. So, and the reason they sell is because they make money. Syndicates, they make money by buying again and selling again. So this is one of the reasons I like buying direct, because you don't get slugged with all those extra fees that a syndicate would. So you're going to have a better return on your money by investing direct easily, just because of the fees.
I find it interesting that your observation is that people will overpay to such a great degree in the commercial space by going to auction. And then I wonder, well, why wouldn't somebody insist on selling at auction if that's really what happens. So it sounds a little bit more like the Wild West, and so you do need a bit of a guide running through that. But also, I think what sounds clear to me is that and we've talked about it a couple of times during this conversation, is that it's certainly for a more mature investor, and that's sort of age mature because you need to have actually accumulated some wealth and some equity using other investment pathways. I guess also is interesting around the yield, and the yield is so important for capital growth, and so they're intrinsically combined, whereas it's the opposite pull really with residential property. As capital growth, you get capital growth, which is really what you want, it's the holy grail, but then your yield goes down. And so people buying, residential property for yield are typically foregoing capital growth, which is precisely what you need to get into this commercial space at a future point of time anyway. So the whole yield versus growth argument or game, I guess, it becomes a little more complex, a little bit more interesting if you're looking to aspire to get into a commercial investment down the track.
Yeah, and like, two parts to your question, like why don't people all sell at those auctions? You've got to have a specific type of commercial property, so branded tenants, your super cheap autos, your McDonald's,
right.
KFCs. So you wouldn't, I guess that's where you attract the non-sophisticated investor, because they just see McDonald's and go, I'll pay anything for that because it's safe.
It's safe.
Yeah. But we're going to be valuing it on like the empty shell of the building, the relatability of it. We don't get too fixated by the tenant. But yeah, you're right. Like probably my most common type of client's equity source is, two. It's either they've got a good business and they've got a big chunk of cash, or they've got a decent portfolio, 5-6 million, and has had that for a decade, and all of a sudden they've got a couple of mil equity. So then they can go buy that $5 million property in one go, just using all their equity. So they get it out, one big hit, and then use that for the deposit. That's very common.
The cash flow for them won't be nearly as good as somebody who does come up with the deposit as cash. Correct. So I guess that's the other thing too, that you could be still looking at negative equity, or negative gearing for a period of time for those sort of investors.
Yeah, so obviously you've got to look at 105% of the loan in those situations. So if they've got a 5, like the average interest rate as of today I'm paying is 4.7 at the moment. So if I was doing a 100% loan, I'd probably want a 6-7% return to factor in a couple of interest rate rises.
Yeah.
There might be a rental increase within 6 months of you owning the property. So, the equation's got to work day one as well.
Yeah, I mean, some of the clients we've had at over the years have done like astronomically well on commercial, like bought factories in, I don't know, Williamstown in Melbourne for 50 grand each, and now they're worth like $5 million. Like, it still comes down to land quality, right? Like it's still, which is what we see in the resi space, get the quality of the land. That's where people really compete on. That's where the income and the wealth sort of gravitates towards for that lifestyle benefit. I think businesses do that, right? They for the business benefit of owning that land, that's what, drives the prices. Interesting is sort of, while in your Dumbo sort of, final question, but where have you seen it go really wrong? Like a risk that, because it can easily happen in resi, right? You buy a place and then all of a sudden you didn't realize you didn't do a DA check, or someone lodged a DA a week after you moved in, and or lots of things, drainage, all sorts of problems. So where have you seen it go really wrong in commercial, where it's an unforeseen risk that you can't rule, your due diligence can't put it, it's not really but you just got to sometimes go, look, that's a leap of faith, or is those leap of faith just too risky in commercial because it's it can be catastrophic? Like, how does it work?
Well, it's a good question. Like, we make sure that sort of big mistake doesn't happen, and it's a very thorough due diligence process. The biggest mistake you could make is if you buy a property that won't be relet again. So there's not many of those around when you come to think about it. There might be some properties that'll have longer vacancies or whatnot, but that's where you're going to get punished by that big vacancy. So that would be the bypass town, or you're not going to buy, like, no one's silly enough to buy a property in a heavily flooded area, because of course you're going to check the flood match. Of course you're going to make sure there's a building test. Okay. You call the council. Unapproved mezzanines are a big one. So people, the agent will overstate the floor space because there might be 1,000 square meter shed and a 200 square meter office that the tenant illegally built. Yeah. Then they might try to charge you, 2,000 a square meter on top of the sale price for that 200 square meter office space. That would show up in a valuation, though. This is the good thing. There are so many protection methods. If you just buy cash without a valuer, without a buyer's agent helping, you probably won't even know you've made a mistake until you try to resell it. So
you're doing evaluation, though, just over there. You're doing evaluation as part of your due diligence. So before you buy it?
So the bank will? Yeah, so we do the equivalent of evaluation, but we also look at the viability of the business. But we know the valuer's job is to check the rent's not overpaid, check the legalities of the property, and making sure the yield matches the yield. So that's what we do anyway, but then you've got an independent valuer doing it, and you've got to pay for the valuation. Big difference with resi to commercial. You know, on a $2 million property, you might be spending $3,000 on a valuation in that case. So that'll be a 50-page report full of all the nuts and bolts of the asset. So when you've got all these third parties plus a good commercial lawyer that makes sure the lease is ironclad, you know, there's a lot of sort of factors of safety there if you do it properly. But if you don't have the right team around you, and you know, and I guess I don't hear about those ones because we've got that team, we've got the good commercial lawyer. We know that the banks will use legitimate valuers, and we know the yield and the square meter rates for the rents anyway. So, you know, you can see through the dud deals quickly, I think, through that.
I mean, with resi, it's clients, especially at the moment, you know, clients will send me 3 or 4 properties. You know, what do you think? Not to say we act as buyers agents, but just as a sounding board to make sure they're heading in the right direction. And we, you know, most of the time we're trying to work with, you know, a local specialist buyer's agent. But I mean, it would be 9 out of 10, right? If not way higher than that, you would say there's a deal breaker. Wouldn't you agree, Veronica? Like, most properties have something wrong with them. What is it sort of in the commercial space where you're like, it's just always a deal breaker? Oh, actually, no, it's, you know, not on the right road. Oh, no, it's too, you know, what percentage of deals do you look at? Do you actively go and consider and try to negotiate on?
So we crash 1 out of 10 on average. So 10% of the deals we put under contract, we crash. Now, the reasons it's that high, like, I think it's a high percentage because we put a lot of work and we get no return out of that. But bad building reports. The most common one is the agent has understated the outgoing. So we get to the true facts and there's actually, oh, sorry, I forgot land tax in the equation. You know, that's $4,000 per annum that you've got to factor in. And then you say, well, I need to get that yield back. We need $60,000 off the price to get that back. And they'll go, oh, the owner said no. So we crash because we don't want a lower yielding asset. Same with building and pest items. We might call the tenant up and the tenant says, I'm actually moving out. This place is too small. Yeah. Or the gym guy says, oh, there's no car spots for the tenants. They're all complaining. You know, it's there's so many reasons we crash. Unapproved mezzanines are a big one. Just we've been misled in the sale unintentionally most of the time. Like the agents kind of rush through, or we buy direct from owners a lot of the time, and it's hard to piece through everything perfectly for information memorandum without missing something. That's where big agencies are good, because they don't want to bring a property to the market unless they've triple checked everything, and then there's less chance things go
wrong. But I mean, like, if let's say there's 100 commercial properties on realcommercial.com.au, right? How many good ones do you reckon are in there? Like, is it 5 or 10% of that market, or is it 2% that you actually think's good? Like,
so the numbers we work off, because we have a team meeting every month and review. Like, we probably review, I don't know, 350 properties per week across the country on and off market. 70% of it's off market too, so huge off market trade, more than resi. And the reason for that is a lot of times they don't want owners or tenants to know they're selling, or they don't. These people are often prominent people in communities. They don't want everyone knowing why they're selling the shopping centre, stuff like that. But out of that 350, we secure about 6 to 7 a week on average, maybe 8 a week. So there's a very high cutoff percentage, and then out of that, a couple, or one crash out of 10. So there's a massive shortlisting that has to happen, because yes, you're right, most of them I wouldn't touch, and the reason I wouldn't touch is they're just overpriced and people are greedy on, and it's, you know, we're looking for the good deals, not the one that's 5% over market.
So I guess there's a little bit different to, say, the way we look at it. Similar percentages, though, I think. And, you know, I'd say there's probably about 2% worth buying in residential. But we wouldn't we would rule them out, not because it was overpriced necessarily. I mean, we'd get to that point, but it's very clear in residential what's a good asset versus what's a mediocre asset versus what's a really bad one. So we just avoid the bad ones and tend to steer away from mediocre as well. Whereas obviously the deal is what might be a big factor in determining whether it's a good opportunity or not in commercial.
Yeah.
So therefore, you do have to consider a lot more than we would. You know, we can just write off properties based on address half the time, whereas you'd have to dig a little deeper before you decide whether you're going to rule it out or not, I presume.
Yeah, 100%. The only time we can really rule out a property without looking at it is if it's a tiny 5,000 person town or not, because we know the banks won't want to come to the party there. But yeah, like it's really tenant dependent, square meter rate dependent, age of the building dependent. And also DA dependent. Like if you're buying a property where they're building 3 new shopping centres in the corridor, then that's going to hurt.
Yeah.
So it takes time to get through it.
Scott, so
Very
good to have you
interesting.
on. I mean, it's definitely something we're keen to cover more and more. And it's a bit of a gap in our elephant in the room, 250 episodes. So thanks so much for coming on. And hopefully there's lots of insights for our listeners.
Thanks so much, guys. Pleasure being here.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.